Ready? We'll get started. I think we've got Greg Quinn from Bloomberg up first.
Good afternoon.
Greg.
I'm sure you're aware there was some controversy in the public and financial markets around the communications of your last rate increase. You had a response to a newspaper and reacting to something an economist at a big bank said. Do you need to do more to keep investors and even the public in the loop and keep financial markets from overreacting when you do change rates?
Well, I think we spilled enough ink on that earlier issue already. As to whether we need to do more is a subject of active discussion at the bank, as it actually always has been. We're always discussing communications and thinking of new ways to go about them. And in fact, just last week we had a conference on the monetary policy framework, and that included a big segment on communications. It was fully webcast, perhaps you saw it. And so we got a number of interesting ideas there around the communications front, which, in general, we're happy to get feedback from people and to engage on debates about these things. And I just point out that an awful lot of people were not surprised by that interest rate decision. How did that happen?
Your speech mentioned a slight overshoot of the inflation target in 2019. Given we've had this long period where inflation has been below the 2% target, are you more willing now to tolerate an overshoot?
So essentially, we have a 1 to 3% band for, I think, exactly that reason. That there's only so much close control, which is theoretically possible. I was at the bank doing as a researcher when we developed the inflation targets, and at that time we were concerned how closely could we control the inflation rate because the transmission is so long. And so we concluded that on that sort of 18 to 24 month horizon, that 1 to 3% was pretty well the theoretical limits of your ability to control. So that's why it exists. And so as it turns out, in the MPR in July, if you look at the chart carefully, you can see there's a very minor overshoot of inflation in the forecast. And that's a product of the model. The model is taking the starting point. And of course, the starting point is below 2%, but we know that over the next 12 months, much of the temporary factors holding inflation down dissipate, and the thing that then drives the inflation outlook is just the output gap, and with that lag. So it's very hard to imagine finding a scenario in which you perfectly get the output gap to close on the pinpoint of at the same point as you get 2%. So the model tries to work that out for us, but it allows for an overshoot. So an overshoot is not something we would ever plan for. Our objective is 2%. But what the range allows you to do is to allow for the fact that something could happen between now and 18 months from now, which throws off the actual inflation outcome, something that's beyond your control.
Next.
Good afternoon, Sue Bailey with Canadian Press. Do you have any thoughts on how infrastructure funding should roll out now that the economy is doing as well as it is?
Well, the infrastructure program is well underway. Some things have started, other things are still in planning phases, et cetera. And I think the government is being quite careful to ensure that those infrastructure projects are, if you like, growth promoting. So what happens with infrastructure is you actually work to increase the capacity of the economy to perform well. So infrastructure could be a significant constraint to growth for some companies. Easing up those limits gives you more potential growth. So it feeds the supply side of the economy as much as the demand side, and therefore it's not just a demand tool. It's to help the economy to adjust better. So I think it's a very positive thing that we're investing in infrastructure.
And you talked a lot, about the risks of household debt. When rates are low, are people not encouraged to borrow more?
Yes, when you reduce interest rates in order to cushion a shock in the economy, essentially the reason it does some work for you is it encourages people to make spending decisions sooner than they otherwise would, and to borrow sooner than they otherwise would. So there's no point denying that. That's part of the transmission mechanism of monetary policy. And so one would say, well, if your objective is to cushion the economy and do your best to keep inflation on target, low interest rates were the recipe for getting that to happen. One of the side effects is that because the shocks were long and persistent, the economy stayed, went through a period where international economies were disappointing us left and right, and so nothing really came back as fast as anybody thought. That became a period of accumulation of debt, which was more than anyone could have imagined back in 2008 or 2010. And so we have a build-up of household debt. That's a side effect of what we've been through. And so our job now is to continue to foster the right kind of growth. The best contribution we can make to financial stability or resilience is to ensure that the economy gets home, as I defined it there, so that people have jobs, they're able to service their debts, they can work them down through time, and avoid the kind of catalyst that could cause them to be a problem.
We got VOCM, NTV, and Reuters, so VOCM first.
Thank you very much. My name is Jerry Lynn Mackey, and as he said, VOCM News, thank you for taking my question. In listening to your speech, it seems like you're very much on the fence as to what the future holds for interest rates in the country. You listed 4 different factors that you'd be watching very closely. None of those factors seem to be really particularly volatile or quickly changing or quickly moving, so I'm just wondering, is this a stalling tactic where you don't want to say which way it's going to go or which way you think the interest rates are going to go? And when will we have a clear indication as to what you foresee will happen with the interest rate?
So the fact is that nobody really knows. We're in uncharted territory in terms of what our economies, and I say economies because we're not alone in this, have been through, and how will they adjust as we move forward. So as indicated in the speech, we need to continue to refine our understanding of those phenomena. Things that are assumed in our models may not operate exactly as they have in the past. And so we have to continually refine that as we gather more data. And so that is an important piece of judgment as we go forward. In a strict mechanical sense, you could suggest that in order to find the economy in full balance or equilibrium or home, as I described it, that interest rates, some economists would say, well, that would mean interest rates would be this number. Well, that would be true only if there's nothing else going on to be a kind of a wedge between that number and where we actually are. So the metaphor I like to use is when you're riding your bike up a hill, you could be pedaling as hard as possible and not moving very much. And so, but when you get to the crest of the hill, sure enough, you pick up speed and you don't need to pedal as hard. So I feel like for the last 7-8 years, we've been working our way up a hill. There's headwinds or a slope there that is holding us from getting back, and that means that we've needed low interest rates longer than anybody expected. So those things constitute a bunch of unknowns that we can't just assume away. We have to continue to try to understand them, and frankly, it's a case of kind of feeling your way as you go along. And when you get to the crest of the hill, it feels easier on your legs, and I think we'll know. And we'll be very open about what our outlook is and what things are holding us back or keeping us from a full understanding or keeping the economy from getting all the way where we expect it to be. So that's our job, and I assure you we'll be as open as possible.
How concerned are you about household debt playing into all this?
Well, as I said, it is our number one risk to financial stability, and I've just outlined. It's a natural consequence of what we've been through. It's not surprising that it has occurred this way. I'm confident, first of all, usually when we analyze that in our FSR, our financial system review, what that is about the stability of our financial system. You know, will there be problems in banks, et cetera, if people run into trouble with their debt? And that analysis, which was published in June, shows that, in fact, the Canadian financial system is highly resilient. Banks now have very strong capital positions and buffers, and in fact, we're underwriting new mortgages even more vigorously than in the past. So people who get a mortgage today are for sure able to pay a rate of interest that's 2 points higher than the one they actually are negotiating. Well, that's an important cushion in a household. It should give you a sense of security. So all that is working well, but that doesn't change the fact that the economy could still behave differently from a macro standpoint. As you know, we've raised interest rates twice. Well, what will be the reaction? Our model tells us what it should be, but it could be a little bigger because of that stock of debt. So we have to be cautious with that and keep gathering data and watching all the signals as we go forward. And well, that's not, I wouldn't label it as a concern, but as a more of an unknown, and one that we need to continue to watch. It's just a vulnerability. And usually those vulnerabilities require some sort of trigger for them to become risks. We talked about the crack in the tree, that kind of thing. Well, so the trigger could be a new recession, let's say, a global recession where we all have a rise in unemployment and it becomes hard for people to pay their mortgages. Well, that interaction would be quite difficult for the economy. It would mean you'd have a bigger recession because of the debt than you would have if the debt wasn't there. And so you'd need more interest rate or other policy actions to try to cushion the blow.
Got Reuters over here.
Yeah.
Hi, Greg Locke, Thomson Reuters.
Right.
What's the sensitivity of the Canadian economy to the value of the Canadian dollar? Is it the current level harmful or beneficial? And if you have a concern, is it the level or the speed of appreciation?
So there's no magic level, and I'm certainly not going to refer to the current level as harmful or beneficial or whatever, any of those things. It is a factor which must be taken into account. So if you have the economy operating as it was, let's say, a year ago, and then you redo your forecast today, lots of things have changed in that time. And one of them would be that the exchange rate has changed. And so the exchange rate has places in our model. In particular, it's in the export it's in the export model, and it's in the import model. And so what happens is the economy is modeled to react to a different exchange rate than what we had a year ago. So it's more about what is it, not about whether it went only in 3 weeks in that time period. It's not about that. It's about what does a business person see, and how is their business reacting? Are they able to continue to price well, let's say, to their U.S. customer, and continue to service those contracts, or does the exchange rate move mean they have to raise their price for the customer, and the customer buys less, or it turns to a different supplier? Those are the kinds of interactions that we're trying to capture in a macroeconomic model. Very complicated. So there's no simple statement about that. It's just one of those things that feeds in, just as we would have a different level for long-term interest rates today than we had last year. We've got all kinds of things that are different today. So you get a new forecast for the economy and for the output gap, and therefore for inflation, and that gives you a different perspective on what's going to come next. So the exchange rate plays directly into it.
Is there something driving what seems to be an urgency in the rate hikes now? Anything in particular?
I'm not sure what you mean by urgency, but in any case, we explained in July very carefully that the situation had advanced significantly in the previous 6 months, a much more synchronous global expansion, better signs from the Canadian economy, A fair bit of closure of our output gap, the outlook for inflation coming much more into focus towards the 2%. And so in that context, we decided it was time to raise rates and that the economy was well positioned for that. And we said at the time that we were moving into a highly data-dependent zone. And then in the course of the next 2 months, the economic data were unambiguously stronger than we'd laid out in the monetary policy report of July. Virtually every data point exceeded our expectations through that period, culminating in the national accounts at the end of August. And so in reflection of that, like data dependence declared, and data much stronger than expected, it was appropriate to adjust the rate upward again. So I've said today that I've laid out the various things that we need to watch. I've said very clearly that we're not on a predetermined course, and that we need to watch some really important unknowns as they evolve as we go forward.
And TV at the back there.
Michael Connors, NTV. You mentioned in your speech how the oil collapse affected this province especially. What is your assessment of how our provincial government handled that, and is it moving in the right direction?
Okay, well, I'm not going to comment on the policies of governments. I'll give you a free one. Go ahead, you can ask a different question.
Okay, well, we don't have lithium crystals in Labrador, but we do have the Muskrat Falls project. The federal government has backed $7.9 billion in loans in that project. It's behind schedule, over budget. It's going to drive up electricity rates. What are your concerns about that project?
Again, I'm sorry, I'm not going to comment on a specific project here or anywhere. So would you like another question? That would be a freebie? I'm sorry. I mean, they're way far outside the bailiwick of monetary policy, and it's not my place to comment on local issues like that.
I think we have time for one or two more questions.
In that case, could I just ask a quick follow? In your speech, you referred to the rise of protectionist sentiment in some areas. Could you expand on that, please?
I think as everyone knows, there are a number of issues arising from the United States right now, which are on the trade front. So there's considerable uncertainty about what trade policies, trade agreements, call them what you wish, will look like for the future. If you're a business person, you don't live in the moment. You're projecting ahead several years. You're trying to be strategic about growing your business, and it must be quite difficult to do if there's a risk that NAFTA will no longer be there for you to operate under, for instance. And so those risks have been highlighted since January in our monetary policy report, the January report, April, and then again in July, is one of the biggest unknowns that we face in a macro sense. And in a trade-dependent economy like Canada, it's a really important piece of our architecture or our infrastructure. So as a business person, I'd be watching that very closely, and I'd be possibly operating in a way that hedges against that risk. And so, so far we've been impressed with how business sentiment has been in Canada. Investment sentiment and business sentiment has been pretty solid despite this uncertainty, and yet everybody we interview talks about that uncertainty. So it's got to be the case that the economy is not performing as well as it would without that uncertainty. So that's the way it works its way into our analysis. Obviously, we don't have specifics to actually figure out how it might affect the economy, except beyond an expectational effect at this stage.
Your last question?
Last question for Greg.
Hello. Some people have already estimated that the economy is already at full output, running full throttle. Mm-hmm. I realize that you're overhauling a lot of your numbers, but is that a possibility that right now we're at full capacity or even a bit beyond that limit?
The amount of uncertainty around what the level of capacity or potential output is sufficient that any of those things are possible, but it's equally possible that it's not the case. Certainly, if you take point estimates from 6 months ago, so on, and then figured out how what GDP has done, the one side of that argument would be have used up the excess capacity. But we know from looking at the labor market that we have more slack than that analysis would suggest. So that's in the output space, whereas the labor market space clearly has some more room to grow. And I talked a bit about youth unemployment and underemployment. So that would be, the potential for expanding the labor force in that way is an important consideration. Productivity, by the way, has accelerated very nicely in Canada. This over the past year and a half. So for example, in the goods producing sector, productivity is rising by over 4% year on year. Our unit labor costs are actually falling in Canada because wages are not keeping up with that productivity gain. These are signs of the other part that I was talking about in the speech, which is that at this stage of the business cycle, when investment becomes a key driver of growth, as opposed to just consumption or housing, which is what's been primarily our driver in the past few years, as investment takes over, presumably supported by export growth, it's usually always linked together, what happens then is some of those firms are not just upgrading their capital equipment, they're expanding. So they're adding to their capacity to produce. That may require a new technology or new workers or a combination of those. We can see from the productivity that the technology is doing some things. So all that to say that when there's a shock like we had from the third quarter, where 4.5% was a huge number, almost certainly some of that surprise is on the supply side of the economy, not just demand. So, I'm not in a position to predict that, but just say that the folks at home are working hard on sorting that out the best we can. But it won't be mechanical, it won't be precise. It's just that we have to give some weight to the possibility that the supply side of the economy is actually expanding more than we build in to the projection, or more than anybody built in when they say, oh, the gap must be closed. That's a mechanical interpretation of the data rather than one which I think at this point in the cycle, usually what happens is we over-predict inflation. And this is why. It's because the economy's supply side grows faster than you build into your forecast, and you don't usually forecast that. It's like a sort of good luck when it happens. And that's just very common at this point of the cycle. And as I discussed today, I think given the length, the persistence of the cycle, we have a bigger chance that it will be a more important phenomenon than we see in a typical business cycle. So the job then is to be watching it unfold and not assuming the answer, right? Which is what I mean by data. So essentially, that's what data dependence is about. It's feeling your way with the data.
And that leaves us out of time.
I'm going to knock that thing off in a second. Sorry.
Thank you very much, everyone. Have a great afternoon.
All right. Thanks, everybody.